Hello, this is Mike Swanson, and I run the website WallStreetWindow.com. And the odds are that you're watching this video because you got an email from me about it telling you that I just put it up for you to watch. Now, if you're not on my stock trading email list, you need to get on it so you can get all my future updates. Typically, there's one every single morning before the opening bell with the top stories I'm watching today in my thoughts on the market, sometimes even in individual trading ideas. So subscribe for free. I'll put a link in the YouTube description for you to do just that. Now, what I want to talk about today is a book that I've been rereading, a classic trading book, one of the key trading books that have influenced me in the top 5 or 2 perhaps out there. And I think I last read it 15 years ago. So I would say this is a book that's a must read for anyone new to trading and a reread to refresh yourself with the contents of it if you haven't read it for some time, which I'm one of those people. It's helping me to reflect on my own trading path by rereading this book and think about the future and what's important as a trader or investor for success. A return to the fundamentals, because it's so easy to lose track of them when you watch the markets every single day. And we've been in a strong uptrend rally in the market since last April. That's brought in many new traders to the market. And really, we've been in a secular bull run since 2009. Yes, we had a crash, so to speak, last year in March, but it was short-lived and we rebounded back. I don't really know very many people at all, no one that had been in the market and then is now completely out of the market because of that drop. There wasn't the type of psychological damage done to people that happened in 2008 or the 2000 to 2002 bull market. So I'm not sure if we can really call what happened last year bear market because it came back so quickly, even though the losses were fairly sizable when it did happen. But now we're in an uptrending market. And I got an email several days ago from someone asking me, what are 2 books I should read? I'm starting out new in this game. I just opened up a Robinhood account. The person was actually telling me. And instead of just touting my book, let me tell you 2 books to read and then some of the things I'm thinking about. So I'm going to share my screen. And the first book I think this person should read and anyone new to the markets needs to read is this one, Stan Weinstein's Secrets for Profiting in Bull and Bear Markets, to explain stage analysis, and how to read the overall trend in the market. And he presents some specific trading methodologies that work. And when I talk about the twofold formula in my book, it's really the best trading pattern timed with one of his trading ideas. I think it's been so long since I read it, but I think it's his optimal buy point for traders, something of that effect. But the other book that I'm reading myself, Reminiscences of a Stock Operator, the one right here. This is I've owned this copy for 20 years. These 2 books are the ones that have had the most impact on me. And this book is written 100 years ago is when it was published. And it serves as a novelistic biography of one of the most successful traders in history, Jesse Livermore. So it's about his story and how he started with nothing and was trading millions of dollars, 100 years ago. And And in fact, he made 100 million during the 1929 stock market crash. I mean, that's probably over $1 billion in today's inflation-adjusted dollars. So, one of the biggest individual traders in market history. And this book is about how he got to that point. How the mistakes he made and the lessons he learned, and their key lessons for us and anyone who wants to navigate the market successfully. Now, I would suggest read his story, get it on Wikipedia. That's what we're looking at here. And here's a picture of him. I'm not going to go into his entire story here. I'm just going to go in a minute at a passage of his book and how it applies to today and things that I'm trying to remind myself of in the moment we're in these markets. But I was curious about this. How many other people are even interested in Jesse Livermore? Because when I started trading in the 90s, his book was considered one of the Bibles of trading. Wall Street firms would, in fact, hand it out to new traders and tell them, read this book. So this has been a famous book, and I was just curious: is it still that way today, or has interest faded away? And this is the Google Trends search data on Jesse Livermore. How many people are interested in Jesse Livermore? Well, the peak of interest, according to this, was March 2005, and we're about 10% of that now. And I use a Google search tool, and it shows that every month there's only 5,400 people typing in his name in the Google search engine. So I would say the interest is fairly small in Jesse Livermore, even though in the 90s it was considered a Bible of trading. And I'm rereading the book now, and it still stands up and holds up, and perhaps is more important than ever before. So not many interest among the masses, but I would suggest, if there's one thing to do now, if you're looking for a book to read, or over the summer or next month, read this book. If you're really into trading or want to learn or maintain your winningness in the markets, you must return to the fundamentals of this book from time to time. So anyway, all that said, I'm going to share with you one of the passages in the book, and we're going to apply it to today. This is chapter 7. I'm not going to give you the page number because this edition's pages is numbered probably differently than any copy you might get. And this book is actually in the public domain, so you can probably even get a free copy somewhere if you search for it on the internet. Probably a free download PDF is available. But I'm going to paraphrase. I'm not going to read this word by word, but in the book, I never hesitate to tell a man that I'm bullish or bearish. But I do not tell people to buy or sell any particular stock. In a bear market, all stocks go down, and in a bull market, they go up. I don't mean, of course, that in a bear market caused by a war, ammunition shares do not go up. I speak in a general sense. But the average man doesn't wish to be told that it is a bull or a bear market. What he desires is to be told specifically which particular stock to buy or sell. He wants to get something for nothing. He does not wish to work. He does not even wish to have to think. It is too much bother to have to count the money that he picks up from the ground. Well, I wasn't that lazy, but I found it easier to think of individual stocks than of the general market, and therefore of individual fluctuations rather of general movements. I had to change, and I did. So when he is writing this, he's looking back on his development as a trader and investor, and this is what took him from being someone that could win in the markets to being one of the leading and largest traders of his day. It was moving away from individual stock picks individual trades into focusing on the what he calls the general conditions of the market itself. What that enabled him to do was, it's what one would call a macro investor today. But making that change enabled him to make larger trades because he's betting on larger trends. You can't put all of your money into one single stock trade, but you can do that when it comes to an individual bet on the macro conditions that you're in, what he calls the general conditions. And being on top of that is the most important thing to do. So when he writes, and it sounds like he's putting down people, but not really. When he says, I don't hesitate to tell a man that I'm bullish or bearish, but what he says is they don't really care to know that. What they want is the individual stock trade idea, the stock tip. And the reason is, he says they're lazy, but forget that. It sounds negative. Think of it this way. It's their focus. Their eyes are on the pick, the tip, the trade, whereas his eyes are on the general conditions. And one reason for that is that when you're in a bull market, the general condition is bullish, and therefore most stocks go up anyway. So the individual tip, the individual stock, isn't necessarily that important, especially if you lump in that stock with the sector it's trading in. So right now, last week we saw gold stocks go up. The GDX gold stock ETF went up. Just about every single mining stock in the big cap complex went up too. There was no real difference between the performance of Newmont and, say, Barrick and Goldfields. At the same time, in March, we saw the NASDAQ 100 correct almost over 15%, and Apple, Amazon, all these technology stocks performed fairly poorly that month. They're now, in fact, still lagging the market, and the S&P and the Dow are performing better than the NASDAQ. They did that when the NASDAQ fell 15%, or I think it was a little 16 higher. The S&P fell less than 4%, and the S&P is still outperforming the NASDAQ. So if someone said to me, should I buy Apple or JP Morgan, I would say JP Morgan. And the answer has nothing to do with the individual business prospects of Apple or the individual trading characteristics of Apple stock versus JP Morgan, but the simple fact that the NASDAQ 100, which is dominated by Apple, is lagging the performance of the S&P 500. So bank stocks as a whole are performing better than big cap technology stocks. Therefore, it's very simple to know that one should own, if the choice is between JP Morgan and Apple, Apple is the answer. And if the question's Tesla versus Caterpillar, the answer is Caterpillar. In fact, I would assert that today the ARK ETF is an ETF to avoid and put the money into other things. Look at what's outperforming. Commodities are outperforming. The CRB Commodity Research Bureau Index made a new 52-week high last week, whereas ARK is still off the high, and this week is performing weaker than the S&P and Dow once again. Avoid ARK, buy commodities. Simple. And it's a concept that is not about individual stock picking or doing that sort of analysis, but the general conditions are now supportive of commodities versus these really popular technology stocks, which dominate the list of the top 100 most owned Robinhood stocks. The things the masses are the most still obsessed with are not that interesting to me at all. And another way to apply this type of idea of the group matters, not the individual position or stock or the tip, is look at the crypto complex. A lot of fascination in Dogecoin. But Dogecoin has absolutely no utility in society. No one uses Dogecoin as money. It was created as a joke cryptocurrency. However, it went up. Why did it go up? Because cryptos went up recently. And when people see Bitcoin go up, they look for other cryptos that could go up too. And that's why Dogecoin went up. But if the cryptos go down, Dogecoin will tip over and go down too. So it's only trading with cryptos. There's nothing special about Dogecoin. And if you like cryptos, you whatever. But that's an example of why trying to pick out individual coins to play crypto, it only works if crypto's bullish and the cryptos are going up. If cryptos are going down, all these coins crash. And we've seen that many times where if Bitcoin goes down, other cryptos go down too, and they're all so volatile. And most of them they're just what they are. They completely collapse. So speculative, but that's what is going on. Let me return to the book. People don't seem to grasp easily the fundamentals of stock trading, which I just basically have explained right there. I have often said that to buy on a rising market is the most comfortable way of buying stocks. Now, the point is not so much to buy as cheap as possible or go short at top prices, but to buy or sell at the right time. When I am bearish and I sell a stock, each sale must be at a lower level than the previous sale. When I'm buying, the reverse is true. I must buy on a rising scale. I don't buy long on a scale down, I buy on a scale up. Now, this is a key concept of trading, and this is the trading method that this is how he made all his money, huge amounts of money. He would buy a position in a stock or group of stocks, and if the position went up from his buy point, he would say, this is showing me I'm correct. And now that I know I'm correct, I'm going to add on. And he would build a bigger position by doing that. Now, if the position declined after his initial first purchase, he would say, okay, my reasons for buying may not be correct. Therefore, I'm not going to buy to average down. I'm going to wait and see, maybe I'm wrong. This is telling me I'm probably wrong. Most people average down and down and down. And it's just the Wall Street adage, sell your losers, let your winners run. Do that periodically. Sell, if you got losing, every once in a while, sell your losing positions, move that money into new stuff that looks promising to you. It's a basic money management thing. Now, I also personally use a rebalancing strategy in a mix of asset classes where there is averaging down and getting out as rallies happen. That does take place, but you're doing that not to try to time things, not to try to expand or contract or limit the size of positions necessarily, and you're investing in multiple things. That's the whole purpose of that trading strategy. But this averaging up and averaging down is something you have to understand how that works. And it's the main method he used. You got to have a money management strategy that's consistent. That's the point of that passage. But I just want to return to you the idea. So this money management strategy was one key. The second key is his focus on general conditions. Those two things are what made him the trader and massive market operator that he became. But let's return to the idea of general conditions. What does this mean? And I particularly want to talk about this now because nobody is thinking about it at all. And he's saying it's the most important thing. And I'm going to tell you it's 100% true. And when you take your eye off general conditions, that's where uh, the consequences really have a negative impact on your trading and investing. And it has for me. And I will give just one example, tell a story, tell one story. I could tell several. They all have the same point to them. So, what he means by general conditions is looking for turning points in the market when you are ending a market cycle, when you're going from bull to bear market. Because when that happens, the entire tactics needed to make money completely changes. Going long stocks ceases to really work. More and more trades fail. And that means it's time to step back, be more cautious, be patient, because if you keep doing this, trading and trading that don't, and the trades work, stop, every trade fails, then you end up losing massive amounts of money. Or if you are a buy and hold investor and you're in a long, drawn out bear market, you lose lots of money. Conversely, if you end a bear market, then you have the greatest investment opportunity or point you possibly get. And you must, if you see it, you must act on it, because that's where the most money is made, by getting in early in a bull market. The real big gains tend to come at the beginning and at the end. So getting in at the beginning is so important. And that's where money management allocation, the rebalancing system I use, works. It helps to get in. It's hard to get in a big position near a bottom, but you can do it if you say, I'm putting 10% into this, and I am willing to do some averaging down. If my 10% position falls to 9%, I'll have an allocation set there. So last year we saw secular bottoms in commodities. We saw that in agriculture. We saw that in energy. Remember when the oil market went negative in the futures trading market? That was a secular bottom, and it happened in commodity stocks across the board. So today, when I look at my account, some of the positions I'm up the most on are positions I bought in I think it was May last year, when after the negative oil print, I bought agriculture related stocks. Mosaic, for example, is one that I still own, and they completely soared. But I bought in what I believe is not just a buy point for several months, but a secular bottom in that sector that's going to last for years. So I got an incredible investment entry point last year in stocks that are paying me nice dividends that I plan on holding. But it happened because I was on top of the general conditions in commodities. Agriculture commodities had been in a bear market since about 2011, and we saw oil futures go negative. Incredible opportunities to get in, an incredible buy point. Most people, opening up these Robinhood accounts, they're focused on these stocks just shooting up the most, and jumping on them. But they're not secular bottoms, that we saw in energy last year, that we saw in commodities last year, that you can buy with confidence and know that you can hold. You can't do that, or you couldn't do that buying airline stocks or something like Norwegian Cruise Line, just because they're moving up fast. In fact, many of those type of plays stalled out last summer and have yet to make new highs from that high of last year. So it's all about being on top of general conditions. So when you see something in a bear market, you look and you got to keep your eyes on it for when that turning point is going to be had. Looks like it's going to be had, because then you have an incredible long-term investment buy point, the best type of buy point you can possibly get. And actually, the Stan Weinstein book, that is his number one entry point. It's several months after, well, really like 6 weeks after a bottom is when what he sees, this great buy point. It's really the first pause in a bull, in the start of a bull market, is this great buy point. But to apply this on the opposite side of things, and this is where we are, a similar sort of similar situation. The mistake I made last year, The best trade I made, I just told you, but the biggest mistake I made last year, one of the biggest mistakes I've ever made, was in the first quarter of 2020. The stock market was rallying in January and February, and I was long stocks, and I was seeing the news of the start of the virus situation in China, and then it spread to Washington State, uh, in some nursing homes, and I remained bullish on my stocks because I was just looking at them, focused on them, focused on the stocks I was owning, watching them go up. And the news, even though I was reading it and seeing it, I wasn't really paying close attention uh, to it. And then the market peaked and it came down about 10% off the high. And at that point, I had then understood and woke up to the fact that this darn news is really serious and it's going to change everything, everything. And therefore, the risks in the stock market are absolutely enormous, and I got to take action. So I basically liquidated in March of last year almost everything I owned, like 95%. Went 95% cash when we fell. I think it was about 10% off the high. So I didn't fall. I lost 10%. I know I lost about 10% of my money from the high, the drawdown. I didn't lose 35% or over 30, which is what the S&P fell, because I acted quick enough, but I still acted where I was down 10%. But I got out because the action of the market was snowballing out of control. It was obvious by then that this is horrible, the news, and it was going to really cause a lot of bad things to happen, and it did. But the mistake I made was not being on top of things much earlier than I was. I should not have, in hindsight, I could have gotten out at the top or just 1% off the top instead of 10% if I had been on top of general conditions. If I had just taken the time to stop and really take the virus situation seriously and what was going on much more seriously than I was. But I didn't, and very few people did, because I was doing what everyone else was doing, focusing on my account, watching the positions, the individual stocks do their thing, and not stopping to think about general conditions, not stopping to think what is going on in the big picture and how might that big picture be changing. And there are warning signs out there, plenty of them. This is a mistake I did not make in this summer of 2008. By January that year, I knew that the banks were in trouble and the market was ignoring it. Or it takes the changes often in the market take time to play out before they can match the changes that are coming in the economy. That's what happened that last year. So I was early, knowing what was to come, and everything crashed. I was able to short the market when it crashed because on top of things. Whereas in 2008, I was not on top of things when conditions changed. So this is something we have to do all the time. We have to ask ourselves, we got to step back and say, what's changing in the structure of the market? What could be changing in the economy that isn't necessarily evident to people now? The only way to really do that is to turn off your brokerage account, because the answers to those questions are not going to be in the individual fluctuations in your stocks. And they're not going to be when you open up a Robinhood account and see the Dow up or down any given day. The price action on any given day does not tell you what the overall structure of the market is and how that might change or what news items are going to be important. So what's going on in these two fields now that could be important? One, I've already mentioned it. Commodities entered a secular bull market last year. That means that trend is going to likely last for years. In bull markets, you get temporary dips from time to time. They are buying opportunities. Now, when we look at the fundamentals, we can see easy confirmation. The Federal Reserve is projecting inflation. The last CPI inflation came in at 2.6% annualized rate. The Federal Reserve has said they're going to do nothing about that. So we're in a dovish Fed situation that's positive for inflation in commodities. So it's an easy macro position to take, and there's no reason to really start to abandon that position until the Federal Reserve says there's inflation or we're going to do something about it. Well, from everything they said, everything going on, that's years in the future. Okay, that's one general condition. Second general condition, the economy at the moment is expanding greatly from where it was a year ago when all the shutdowns happened. Earnings are exploding, earnings growth that is, because the comparisons are being made with the worst of the shutdowns. The stock market has rallied substantially. Earnings by itself does not mean the stock market's a great investment, because that doesn't forecast where things are going to be by the end of the year with the economy. What's the economic growth going to be like? We're in a growth spurt. How long is that going to last, and what's it going to be like when it's over? Frankly, I don't know. And so I'm admitting to myself, I'm not really certain what's going to happen at the end of the year. So I'm not going to bet on that one way or the other, or try to make decisions guessing something I'm not confident that I know. So what can we look at that we can be confident about? The structure of the market. What's going on with the stock market? Well, last year we saw tremendous rallies in everything. But when we look at the market now, it's changing. It started to change in February, and it seems like these changes are going to be the definition going forward, probably for at least for months, probably for the rest of the year. What is these changes? Well, we're seeing a rotation out of technology stocks, the stocks that were the big winners last year, and into stocks and sectors that are perceived to benefit the most from the reopenings in the economy. And they're also, frankly, not priced as highly when it comes to things as price to sales and PE ratios on their earnings. In other words, we're seeing weakness in ARK ETF type stocks that it holds, and more strength in banks, real estate, commodities, which I already mentioned, retail stores, different things are performing better. That's likely to be a shift that's only going to continue in the market. That's a part of the general conditions. Now, there's times in which when you see former leaders of the market all of a sudden start to lag, it's a giant warning sign that what you're seeing is a topping process being made. What's called a stage 3 top in the Stein-Weinstein book. Doesn't mean the stock market's going to collapse this week or next month, but it's a potential warning sign. Not necessarily. It could just be a rotation into future leaders that are going to continue to push the averages up. But either way, it's a suggestion that these big cap tech stocks, either way, really aren't worth messing around with. So that's something that's going on. That's obvious. It's a fact. It's the only question is, what does it mean? What's the end meaning of that? Fundamentally, not 100% sure, but from a practical matter, we know that it means trading in these big cap tech stocks, unless it's day trading, but buying and holding them, the FAD stocks, very difficult at this point. So that's the structure of the market that is changing, and it's part of the general conditions. It's one of the aspects of general conditions. What is general? Again, general conditions is the most important factor in long-term trading and investing, because what it means is only by focusing on that can you spot the turning points in the market that are so critical when it comes to an investment and trading career in the long run. It's not the stock trade, it's not the stock pick, but it's recognizing the change in general conditions that creates the best opportunities in the market, and it's necessary to adjust when they change, when the general conditions change time to time. And so again, I will have to repeat, this guy is one of the most successful traders ever in the financial markets. And his number one thing is general conditions is the most important thing to focus on. And it's something that very few people focus on, especially when you're in a bull market, because the general conditions are good and you don't have to think about them until they end. And therefore, people focus on what stock should I buy? What stock should I buy? What stock should I buy? And they don't realize things have changed until it's too late. And that's where we are now. You know, I'm not saying at all we're in a bear market or we're about to hit a huge correction or anything like that. But I am saying that this general conditions is something we must keep our eyes on. And I'm going to dedicate myself to doing that, because I didn't do it in the first quarter last year, and it led to a giant mistake. I only lost 10% of my money to draw down from the high. But if I was focusing on that and on top of it, I could have not simply lost less money, but I could have shorted the market or done some sort of short trades and made a lot of money, because there was plenty of warning signs that the market was going to drop the way it did. I didn't recognize, what I did was recognize the trend had changed and reacted it, you know, on a 10% drawdown in time to escape the sort of losses most people took. But if I was on top of things, you know, I could have recognized what was happening. And few people are on top of things at the right moment. Who was on top of the secular bottom in commodities except a handful of people? You know, no one talked about it in the financial media at all. Only a handful of people out there. And we must be on top of general conditions. So I'm going to dedicate myself to once a month, spending an entire day just thinking about that, studying that question about the general conditions. And that's my answer to how to be on top of it myself. So read the Stan Weinstein story in Reminiscences of a Stock Operator. Read his bio in Wikipedia first, and then get the book. So the book doesn't call him by name. It's a story based on his story. And read the Stan Weinstein book, Secrets to Profiting in Bull and Bear Markets. Get these two books, study them. They will help you win at the markets, or win even more if you're already winning, and maintain that winning streak when the general conditions do eventually change. And there are differences now. In fact, how the market's trading now, what's working now, than just 90 days ago. So all that said, good talking with you today, and I'll talk with you later on. And if you're new to YouTube and me, if you're new to me on YouTube, click the subscribe button on this YouTube video, and then click the bell so YouTube will send you an alert when my next video is posted for you to watch. And I gotta end the video.